Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Okay, welcome everyone to the top stock pick for Tuesday, September 3rd. My name's Andrew Rocco. I'm a stock strategist here at Zacks Investment Research. I'm also the manager of the Tech Innovators portfolio, and I will be presenting my top stock. So hope everyone had a great extended weekend, and let's jump right into it. So my top stock pick is going to be a Zacks ranked number one strong buy stock, PayPal, ticker symbol PYPL. And PayPal has emerged as one of the largest online payment solution providers on the back of its strong product portfolio and two-sided platform that enables it to offer smooth and secure transaction facility to both customers and merchants. So really, PayPal's biggest business and its fastest growing part of the business is Venmo. And the key catalyst behind that growth is solid growth in its TPV, which is total payment volume. Venmo is driving the active accounts base of the company with the aid of strong monetization efforts and robust features. Moreover, PayPal poses a serious challenge to Block, which is formerly Square, growing online presence in the online payment space. And so Venmo is taking market share essentially from some of its competitors, and it's accelerating mobile volume. Robust mobile checkout services is contributing further to its merchant side of the business. So one thing I've noticed is in Miami, there's a lot of crowded areas where you have to valet your car, for example, and a lot of these valet stations I've noticed, rather than just take cash, because a lot of people don't carry cash on them nowadays, they're just Venmo. So Venmo is definitely becoming more popular. The way they make money is they take a tiny percentage of that Venmo payment, but over a long series of transactions, they're going to make a nice revenue from that. And here you can see the rise of Venmo. It only does go to 2021, but back in 2015, they were only doing 1.3 billion, and now they're doing far more than 60 billion. So that's exactly the kind of hockey stick growth we want to see. And the application, as I said, it enables the transfer of money between family and friends via mobile devices. The company is constantly adding new features to the app, and Venmo users can now pay at more than 2 million PayPal merchants across the United States. Again, I've noticed the valet, my barber is accepting Venmo. And again, oftentimes people like me, we're not carrying around a lot of cash. We just have our card. But Venmo is a nice, easy, and quick way to do it. It also does have a social side of it, so you can see what your friends are doing for payments. I just signed up for fantasy football. Everyone Venmoed the league manager our pay. So I've noticed it in my own life. It's kind of that Peter Lynch aspect of investing, where you want to pay attention to what you're using in your own life, because often that can translate well to the investing world, and it can give you that extra conviction. Moreover, the company's ongoing partnership with MasterCard will continue to aid the adoption rate of Venmo. With all these, Venmo will continue to deploy more and more merchants across major brands. And then not only does it have a partnership with MasterCard, it also has an ongoing partnership with Visa, which has expanded into Europe, Asia Pacific, to provide enhanced consumer choice, point of sale acceptance, instant money withdrawal facility, and data quality. Partnership provides certain economic incentives to the company, such as Visa incentives for increased volume and greater long-term Visa fee certainty. So Visa and MasterCard, these are the two leaders in the credit card space. So they have those locked up. Their partnership also extends to companies like Google, Facebook, Pinterest, Alibaba, which is the largest e-commerce platform in China. Additionally, the the introduction of new services and offers for the debit and credit card users by collaborating with JP Morgan and Bank of America. That has also attracted new customers to the platform. So even though PayPal's been around for a while, they continue to forge these new partnerships that are helping them to expand the business. And PayPal, any of you who were trading around that crazy post-COVID pandemic time will remember PayPal as a pandemic darling. And like a lot of those pandemic darlings, the stock has kind of come back down to earth. For example, in 2021, it was trading as high as 300 per share. Now it's back below 100. And it's kind of been underperforming up until just like the last few months. However, unlike other pandemic darlings, PayPal has a real business. PayPal's safety and simplicity of transactions and the fact that it's both brand and technology pioneer differentiates it from its competitors, and it makes the company noteworthy. So a lot of these other pandemic darlings, yes, they moved up a lot. Yes, their earnings were growing at the time, but their businesses have really fallen off. PayPal still is a massive business. And what we like to look for at Zacks Investment Research is not what the earnings are doing now. What's more important is future. So you can see this is the earnings line, and then the dotted line is the consensus estimate. These earnings are already at new highs with the stock well off those pandemic highs, and they're only expected to go much higher all the way into 2027. So the price has come down a lot. Earnings are still at the high. It's becoming very interesting just from a reversion to the mean perspective, in my view. And the forward expectations and the estimate revisions underscore that. So in the last 60 days for the current quarter, 7 of the analysts tracked by Zacks have increased their estimate revision, while only 2 have decreased it. And then into 2025, that's the most impressive one. Just over the long term into 2024, 2025, you see 11 analysts have increased their expectations, while only 1 has decreased it. So for now, the growth of the company is roughly flat after declining for several quarters. However, the company is making that turn, and analysts believe the turn is going to be sustained and even increased over the next few years, as I mentioned. Also, one thing I like to look for is industry group strength. So last week, Affirm did really well. Block is turning up. Even though they're a competitor, we still want to see them doing well. And then Upstart Holdings is doing very well. We do own that one in the tech innovators portfolio. We're up more than 20% in that name. So you're seeing this fintech industry group really start to gain traction here, even kind of in a tough overall economic environment. So we're seeing strength in fintech. And as I like to say, birds of a feather tend to flock together. That holds true in the investing world as well. On to the EPS surprise history. Really impressive over the last few quarters. You can see last quarter, they beat Zacks consensus estimates by roughly 24%. They've beaten it every quarter over the last few quarters with an average surprise of 14%. So we have those strong estimates going forward. And then their earnings history tells us that the company has a propensity to beat those expectations. And then the valuation. So we're seeing the growth come back, and the valuation is super low. The price to sales going forward for the next 12 months is near a 5-year low. So the current price to sales is 1.98. The 5-year low is 1.74, and it was as high as 13.62. But anyway, the price to sales is lower than its sub-industry, which is 2.43x. The sector is 6.36, and the S&P is 4.95. So just about from any perspective, it's cheap on a price to sales and valuation perspective as that growth comes in. So it's turning out to be a classic growth at a reasonable price play, or what we like to call a GARP play on Wall Street. So that's kind of another avenue. It might attract both growth and value investors, which you love to see. And then the 13F statement recently came out, and it showed that Tudor Investment Corp, founded by legendary trader Paul Tudor Jones, revealed initiating a stake in PayPal Holdings, acquiring 888,000 shares, valued at roughly $60 million in early 2024. They also have call options, so an aggressive position for Paul Tudor Jones. And he's one of the sharpest investors on Wall Street. In case you don't know who he is, he's famous for shorting the Black Monday, for predicting and shorting correctly the Black Monday crash of 1987, which propelled him to being a billionaire philanthropist. And as you guys know, I always like to look at the technicals. Right now, we're looking at a daily chart. Two things I like about this chart. Number one, you see this long, frustrating range, but now we've broken out of that range, and resistance, old resistance, has become support. So as long as we stay over that 70 level, call it 68 level, over the coming months, that breakout is intact. And we saw the faster moving average on this chart, the 50-day moving average, cross above the 200-day moving average, triggering a classic golden cross, which is a long-term bullish technical signal. Now, if we zoom out even further to the monthly chart, we see that the stock is pulling into decade-long support, or just about 9-year-old support. So that old support should hold. You can see the nice run that the stock went on. It came all the way back. I think it's overdone to the downside based on those forward growth projections. And that old support should hold, in my view. And then finally, from a macro perspective, the answer to this question, will interest rates go down in 2024? The answer is yes, according to Fed Chair Jerome Powell. He basically confirmed that last week. And lower interest rates can be bullish for a company like PayPal because they reduce borrowing costs, making it cheaper for consumers to take on debt and spend more. This can also increase transaction volumes on PayPal's platform. So we're seeing all these partnerships, the growth in Venmo. It's really a good macroeconomic atmosphere for a company like PayPal. So for all those reasons, I expect the stock higher over this next 6 to 12 months. Again, my top stock pick was PayPal. Zacks ranked number one, strong buy, ticker symbol TYL. That's going to do it for me, but I'm going to pass it on to my colleague Tracy, who's going to cover the top stock pick of the week. Thank you so much all for.
Thanks, Andrew. So my number one stock is a little different from what Andrew just talked about because it's in retail. Yes, there is a number one stock in the retail sector right now, and it's been a big winner all year. It's Abercrombie Fitch, ticker ANF. And why do I like it? Well, not only is it a Zacks number one strong buy after its recent earnings report, but it's one of the rare stocks that also has A's in the style scores, which is the highest of the style scores across the board, and a VGM of A as well. So it's basically perfection on both the rank and the style scores. So let's take a look. What does that even look like? So on the Zacks.com, when I put in the ticker, I'm getting the Zacks rank up here. As you can see, it's got the number one rank. And then here's the beauty, the style scores across the board. Now, on the industry rank, however, it is in the bottom 40%. So normally I wouldn't really like that industry rank. And we all know why retail is kind of in the bottom, because nobody knows what the consumer is going to do later this year into the holiday season. And even Abercrombie Fitch themselves said on their recent earnings report that the economic environment was uncertain, and they were not certain themselves what the consumer is going to be doing over the next couple of months. But we do know what they've done in the rear view mirror. And with Abercrombie, it's just stellar. So they have had tremendous same-store sales in both of their brands, really, in both Abercrombie and the Hollister brand, which is geared towards the younger set. Now, Abercrombie used to be more of a teen retailer or teen kind of early 20s, but they have retooled and relaunched as more of a mid 20s, upper 20s. And secretly, I even know some in their 40s who are kind of shopping there. So this is good for a retailer to expand their customer base and to get out of the kind of fickle teenage market and into more of the adult market, certainly in their 20s, where they're attending a lot of events, they're going to weddings, they have a whole new wedding division. They've started selling dresses for women, suits for men, and those have been selling well over the last year. Now, how about those comps? Double digits for Abercrombie this year. I have to take a look what it was at. So Abercrombie at 21%. These are the same store sales year over year. Hollister, though, also at 15%, and that's a really strong number for Hollister. So I went back and looked to see what did they do last year. Is this just coming off of low comps? But no, they both divisions were pretty solid last year too, certainly Abercrombie. So Abercrombie was at 23% last year. Hollister was a bit lower at 5%. But still, when you see on the 2-year stack, these are same store sales. So you are going up, 21% one year on the sales, and then you're going past that number and you're doing another 21 or 23% the next year. That is incredible. 44% comps for Abercrombie in a 2-year stack. And yes, the year prior, 2022, was before the big turnaround where they started with their new product, new ideas, and trying to rejuvenate the brand. But still, to see these kind of numbers over the 2-year stack is really impressive. Now, what does this look like for the actual earnings estimates? I wanted to show those because that's where we get the Zacks rank. Now, they've been raising the earnings estimates the last couple of quarters because things have been better than expected. But you can see here in fiscal 2025, we're seeing earnings growth of 60%. This is just showing those strong comps. They made $628 last year, expect to make $1008 this year. But look at next year. The analysts really are unsure. They're keeping it at basically the same for now because who knows what's going to be happening at this time a year from now. We could be in a recession. The consumer could have really pulled back. There could be more layoffs. Nobody knows. So the analysts are being pretty calm about what's going to come in the future. But look at these earnings estimates revisions after this last earnings report. 4 are higher in the last week. For this year and also for next year. So the analysts aren't as gloomy because the company isn't as gloomy. And look at these changes, 1008 now for this year, up from 957 because the company continues to beat. And if we scroll down some more, you can see the earnings surprise history. Another big beat, 36 cents that they just reported, but that's on top of, look at all these big beats here other than this final for fiscal 2024, but even still a nice beat, and it's averaging here almost 28% earnings surprise over the last quarters. Everyone keeps waiting for it to slow because they're certain the consumer will pull back. But with some of these brands that are just so on point, they're able to lure in the buyers, even with these uncertainties, the bigger layoffs. There's still enough shoppers all going to the top brands that the top brands can sustain this kind of momentum. The not so top brands would not be able to. So what does this look like on the price and consensus chart? That's the one I always like to look at. It's one of my favorites. And you can see up and to the right, that's what we like to see. It has been pretty stiff here. And sharply rising, because this turnaround is fairly recent, as I mentioned, you can see 2022 where they were still struggling before they rolled out all of these new initiatives, the new product that is really resonating. Now, the stock has soared this year. I know what you're thinking, like, it's too red hot. I can't do it here. Well, it was up 89% recently before the earnings, but it has fallen in the last 3 months, as you can kind of see right here. It's pulled back. It rallied again. Now it's pulled back off this last earnings because of the uncertainty about what may happen going forward. And a lot of people have a lot of profits in it, so they're getting out. But this allows those of us who haven't been in it yet to maybe take another look on these pullbacks. Shares are down about 16% over the last 3 months. Maybe you're thinking it might pull back further, and maybe it will if we start to get negative employment reports, for instance, or we start to really believe that we are in that recession. Consumer names will pull back, and maybe this one will too. However, given the earnings growth, it is actually kind of cheap here. It's trading at 14 times forward earnings. So that's in the value area, and that's why it's got that A for the value style score. So even with the big surge over the last 2 years, the shares are still attractive here. But like I mentioned, when you get these headlines coming in of the consumer pulling back, even if it's in another brand, then you will probably see these shares weaken some more. And it will be a true, real buying opportunity at any point there on further pullbacks. But you have to like that some of these retailers are still going full throttle, and they've made the adjustments in their product. They have the name brand, and strong brands do survive recessions and survive them quite well. So look for buying opportunities on this strong brand on Abercrombie and Fitch, and wait on the sidelines for it. It probably will be coming, but I'm keeping my eye on this Zacks #1 rank. As the value stock strategist here at Zacks, it's looking pretty attractive here. So I'm liking these top brands on the retail side, even with the uncertainty. So Abercrombie and Fitch, perfection across the board. Zacks #1 rank, style scores of A, VGM composite score of A. It doesn't get better than that. Ticker ANF. And as always, be sure to tune in every week as we bring you these Zacks #1 ranked stocks, because there are lots of them, over 200 Zacks #1 ranks every week. The rank can change daily. So be sure to tune in for the top stock picks and get a couple of them. We bring them to you every beginning of every week. So tune in, join us here on YouTube, Zacks.com/YouTube, to get all of our videos. And we'll see you again next week with some more top stock